Thank you very much for this opportunity to basically share information around financial planning. What we call fast check management is getting to understand how do we manage our finances at a younger age. I presume that most of us who are attending this program, you maybe it's between the age of 25 to 35. And that's basically the stage we call fast check management. And I will be taking you through this presentation in just maybe about 45 minutes, and then we will have questions. Let me see if I can minimize this. So first of all, about Octagon Africa, our vision is basically enriching lives through innovative financial services and solutions. We ensure that when you come across us, you basically get to learn a lot more about financial services and solutions that will run around your life. Our mission is to safeguard financial future of our customers through lifelong learning and management of retirement benefits and risk management. In terms of Octagon Africa is an award-winning company. Just on Friday last week, we won the top 100 medium-sized companies in Kenya. In the category of digitization and transformation, which is a fantastic thing for us because we have been focusing on digitization over the last 4 to 5 years, basically trying to get to see how do we get our members to save comfortably from their houses or whatever they are. They can be able to log in and save and track their payments or track their savings in terms of income and everything else around financial planning. We are in 4 strategic divisions. We do pensions, insurance, training, and actuarial services. Ideally, we are in Kenya, in Uganda, and Zambia. In all these 3 countries, we are providing pension services to corporates, to SMEs, to individuals, and also we provide insurance services in terms of broking services to various categories of membership of community in the countries. And we run a training company called the Institute of Pension Management, which basically focuses on training people who are saving on retirement and also training on corporate governance. We currently administer assets in excess of 1 billion Kenya shillings, $1 billion US, and over 250,000 members. We run an insurance broking business, as mentioned, in the 3 countries. We have over 100 million, underwritten over 100 million premiums over the last 1 year. Training in terms of having trained over 5,000 trustees, I think, counting, and over 100,000 members. Of course, during COVID period, we have trained much more there. We do a lot of programs on training members on this program that we call Fast Check Management. I'll touch a little bit about mid-career financial planning for those people who are between 35 to 45. And we run a whole program on pre-retirement planning, which I'll touch a little bit. And that is for people who are above 45, because once you get to 45, basically, then you start thinking about what do you do in retirement and how do you live retirement. How do you have a well-being in retirement and live in dignity? So that comes a critical bit when somebody hits around 45 going forward. Now, we are licensed by the pension and insurance authorities in Kenya, Uganda, and Zambia to be able to provide these services. We go straight to our subject today, and I always start with this very particular graph, which shows the stages of life. One of the things that we always must understand that we have a sort of a roadmap that we are basically walking on planet Earth. I know sometimes it takes 70 years, it takes 80 years. It looks like It's just long, it's long, and you get confused in between there. You get lost in between there. But why are we doing this? Is to make sure that we actually don't get lost in these things, that we are conscious of our environment, of our age. We are conscious of what should be happening at around what ages. That way, it helps us to be in control of our finance, to be in control of our social life, and to be in control of our destinies. So one of the things we must understand is that there are 11 stages in life. The first stage is, of course, the 1 to 7 years, which is basically baby class and going to nursery school. So it's starting of life at that very particular time. And then 8 to 14 years is primary and secondary and rites of passage. At that time, basically, you look at most communities, people are doing circumcision for children and things like that. So passing and getting to have rites of passage in terms of where you're moving from being young to being a young adult. 15 to 21 is secondary and university and young adult. Of course, we believe that as an organization, we believe that most people start forming their minds about financial life and financial being between the age of 15 to the age of 21. And for that reason, we're running a program for financial literacy for children, which is between the age of 15 to 21. Whenever they are in school, whenever they are off school, we run a program, a webinar for these children, just to help them understand. The reason why is because I've done this work, I've done this service, selling savings and helping people to save for the last 32 years. And sometimes you meet people and you are telling them about saving for retirement or saving basically in their lifetime and putting money into assets. And some people look at it from a point, you are going to steal my money or you are going to lose my money. It's not because basically that is what they are thinking about. It's because they have not had a background of understanding financial literacy. So financial literacy really needs to start around age 15. Of course, in developed countries, they start teaching children at the age of 7 in terms of financial literacy. Now, if you go to the stage 4, which is 22 to 28, it's a very critical stage. And if some of you or most of you are in this particular category, it is like the foundation stage for life. It's like laying the background to be able to build the house. So you're getting employed at that particular time. You're making a vision of your life. It is a visioneering stage, what we call when we're doing financial induction programs for organizations. It is a visioneering stage. It is a stage where you must start asking yourself, what do I want to be when I reach to stage 10? What do I want? What do I want to be when I reach at stage 6? What do I want to be when I reach stage 5? What is it that is going to make me know that I have reached stage 5? I've reached stage 6. I've reached stage 7. So you sort of like at this age, you want to draw your roadmap. Now I know sometimes people may say, it's basically illusionary. It's not a fact because you are not there yet. But life is not about being there yet. It's about being there yet. Is that asking yourself, what do I want to be at the age 35? And what is it that will show me that I have achieved at that particular age, what I wanted to achieve at that particular age 35. So visioning becomes critical. At this particular moment, if you don't lay your vision, you will definitely jump on somebody's bandwagon and they will take you to wherever they want to take you, their friends, or if they are spouses that may not necessarily be doing it right, or even their parents. Sometimes some of us basically live in our parents' vision because we have not set our own vision. I remember when I left university, I had one vision, is basically to retire at the age of 45. That was my objective number one, is to retire at the age of 45. Of course, I retired much earlier at the age of 36. But one of the things is that if you don't set a vision, then you don't have a direction in which you are going to go. You get it? So you must start setting a vision. So apart from just finance, the whole area of life, the whole area of life, which is basically the social life, the financial life, which is basically economic life, and your whole life in terms of even marriage and things like that. People have to sit in 22 to 28 and decide, how many children do I want to have? How do I want these children to go to school? What kind of schools do I want them to go to? What kind of life do I want them to live? It's very critical. So if you are able to set your vision right at the age of 25, then it becomes very easy for you to start living a life, because then you start asking yourself, and when I get to age 35, I should have made some investments, because my vision is to have raised investments of maybe $1 million, or maybe $100,000 or $10,000, whatever that you would want to think about. But there must be a certain item or a certain objective that you want to meet when you get to a certain particular age group. That becomes very important. Now, of course, 29 to 35 is basically again still managing your early lives, because what happens, some people go to the extent of getting married towards 35, some of them after 35, which is all okay. You decide whether you want to enjoy your life early or enjoy your life later. So if you get married late, you enjoy your life early, then at the end you go through some slight suffering. If you get married early, you suffer a little bit, because you basically get the family and everybody else around you to be able to manage in a city. But then you exit that very particular platform much earlier at the end, and you retire at the end in a better way. So you choose how you want to do, and it doesn't matter. Everybody chooses what they want to do. But the question is that we must ask ourselves, what are we doing between the age of 29 to 35? This is an age of investments. This is an age where we need to have savings. We need to have raised savings, and that money that we have put in savings, we start putting in investments, because without savings, you can never have investment. You can't just wake up in the morning and say, I want to do an investment. Of course, you must have savings. Either you are in a circle, savings and credit organization, or you have saved in a bank, or you have saved in an investment club, or you have saved in a pension plan, or you have saved, all those unit trust or investment clubs, as we'll be able to see in a while. So you must ask yourself, what am I investing in with these savings I have made? Because once you start employment, you must raise your capital. You must raise your money in terms of savings. I always tell people is that you must raise a war chest. You must raise a war chest. I told my son when he started working, I said, look here, where you are going in future, financially, it's a war. It's a battle. You will be battling against costs that come to you every other morning, expenses that fly in your face. You like it or not, you'll have to go through those expenses, because your own expenses, if you decide you're not getting a family, your parents' expenses will hit you. The people around you basically will create expenses for you. So the idea is that you must raise savings from the age of 25 to the age of 35. You must raise savings, and those savings will help you in the later stage of 35 to 45 and 45 above. So savings is a critical bit. The first thing that you must do when you start working is to ask yourself, where do I save? What are my savings avenues? What are my savings opportunities that I have for me? It's not about when you start getting employed, and the thing is, you want to go around and travel with your friends and all things like that, which is fantastic. But it must be a planned process. You cannot be waking up in the morning and basically spending all your salary in something that is not appreciating, in something that basically is not seen the next morning. So what you should be asking yourself is that at least you must, at the early stage, you must raise 30 to 40% in savings. 30 to 40% in savings. I know it looks a lot, But when you're young, you don't have a lot of liabilities. You don't have a lot of responsibilities. I know in African setups, of course, we have dependents, yeah, but you must manage between dependents and yourself, because if you do all through your dependents, then you'll find yourself basically getting into the position where you become a dependent very quickly. So the thing is, you must start saving between the age of 22 to the age of 35. And also it's a stage where you start putting money in investments. We'll be able to see what are the type of investments that we want to put in those assets. Then, of course, 36 to 42 is an age of promotion and expansion. In most cases, when people reach the age of 35, 36, well, some of them have made substantial or dangerous decisions which have put them in positions that are poorly in terms of economic. Some of them have made decisions that are not right, maybe in terms of family. So you find that at the stage between 35 and 45, in a social like it's called social, it's called a social crisis. You know, it is a crisis. It's a midlife crisis. It's a crisis that all of us go through. So if you are here today, you are not 35 yet. Remember that between 35 and 45, it is always a crisis. And it's a crisis because you feel like you do not know where you're coming from, and you don't know where you are, and you don't know where you're going to. You know, now if you had a vision at the start, it actually can be able to guide you. It becomes like a radar that is able to help you know this is the direction you're going. Exactly. You may have taken, you may have diverged into something else, but there is a, sort of like a light in darkness telling you that is where I need to be. But if you don't have a vision at all, if you do not create your own vision when you started working, what happens is in that darkness, you just find yourself in a direction that you don't know. And in most cases, I say, like, when I do advisory, this particular age group, I say this is the age group where people get into addictions. Why? It's because they feel that there's too much pressure and the stress becomes too high. So you must look for a place to be able to get a valve out. And the valve out normally is addictions. And those addictions then doesn't end us in a good place, So 35 to 45 is always what you call a midlife crisis. Now, if you didn't have enough savings between 25 to 35 and some level of investments between 25 to 35, and you get into 35 to 45 in what we call midlife crisis, then you add on what we call midlife financial crisis. Those two crises become basically a dead trap for anybody who has not planned their lives over the last 10 years. So it is very critical that at the start of working, one must be very focused and purposeful to plan their lives and have a vision and have a mission statement and say, this is what I want to do. And to be able to achieve this is how I want to do what I want to do. So that way, then you have a direction in terms of what you're doing. So 35, 45, is a critical stage. Of course, 45 to, 43 to 49 is children graduating. So of course, some children getting out of school. Some of us will be in the middle in terms of educating children. So it's a time of celebrations and other things like that. Of course, 50 to 60, so 56 is retirement begins. And people start thinking about what is it that I want to do in retirement. In fact, I always tell people that when you get to age 45, you must start telling yourself, in the event the employer tells me, thank you very much, can I survive out there? Because in Africa, where the population below the age of 30 is about 70%, we have more people looking for jobs, and we have more people getting skilled, than people who are about 45 and 50. So very few employers would want to employ you between the age of 45 and 50, unless the skill is completely a great skill. So which means that if you exit at that particular time, you're likely not going to be able to have formal employment. So the question you're asking yourself, what is it that's going to occupy me at that particular time? Do I have a home? Do I have a medical scheme for myself? Have I managed off my children, off my budget? So all these things start coming through between the age of 45 to the age of 56, of 55. And of course, over that, we have years where we quit jobs and go, where do we go? And I have, as I mentioned, who takes care of you 64 to 70 and 71 to going forward? We're looking at years of bonus. So this is basically a life cycle, and I really want to stress that between the age of 25 to 35 is a critical developmental stage. The first 10 years are critical because they are going to affect you in the next 10 years and in the last 10 years. A human being has 30 years of usefulness or energy that is able to apply. So we must ask ourselves, how are we doing that? Now, when we're looking at wealth management, how do we start managing our wealth? The first stage around the age of 20 is wealth creation. It's basically saving, budgeting and saving is a very critical stage at that particular time. So you have to start budgeting from day one when you start getting employed. Let me tell you, budgeting is critical. And it's a culture issue. If we can be able to be cultured to budget our finances every month or every year, so you start a year, you are saying, this year, what am I going to do with my money? Am I going to put my money? Am I going to buy a plot? Am I going to buy a car? Am I going to buy a house? Am I going to, things that are maybe major purchases, but then also there are also minor purchases that needs to be bought. Maybe clothes, maybe beddings. All these things must be budgeted, and the only way to do that is to have a written budget. When I train about this, I say most of us think that we have already our budget in our heads. So why do I want to budget for my money? I know I earn $1,000 or I earn to $1,200, well, $2,000. I know that what comes in my bank is maybe $700 or $800. And you know very well that money will be used for paying rent and those kind of things like that. But let me tell you one thing is that if you want to be rich, you must be conscious about the cents, not the shillings. You must be conscious about the cents, because the cents will make you money or will grow your finances. Most of us are conscious about the shillings, not the cents. So what happens is that somebody said in the first week of the month, you go to the shop, you buy something, the shopkeeper gives you change. Say, please keep change. In the middle of the month, you go to the shop, you buy something, please give me my change. At the end of the month, you are borrowing, because you're telling the shopkeeper, give me so that I can be able to give you at the end of the month. Why? It's because you've not been conscious about your cents. So you must budget for you to be able to survive a financial life. You must start by budgeting. And budgeting is not about how much you earn. It's about where you spend your money. I'll give you a very simple example. A gentleman came to my office for financial advice, and he told me he earns $3,000 per month, but what goes to the bank is something like about $40, about $20 to $30. That's what goes in the bank. That's what goes in the bank. But his top line is $3,000. I ask him, where did you take this money? And of course, he explains to me where he has taken the money. He has borrowed loan 1, loan 2, loan 3, loan 5, borrowed one loan to cover another loan. All this kind of indebtedness that we get involved in. And I tell him, look here, we will start by budgeting. Then he asks me, how do you budget for $40? Yeah. And I'm earning a salary of $3,000. And I told him it's not about the $40 you are earning. It's about, we want to know, where does the balance of the money go to? Where does the balance of the money go to? We will understand some money goes into loans, but there's some money which is going into cracks. We must ask ourselves, what are those cracks? It's very important. And the best way is that you must look at your budget every other month. Every time you have done shopping for your month, you come back home, you'll be able to see, what have I bought? Is it within what I budgeted for? If I have overshot, I must have a reason. If I am within my budget, I must ask myself, where is the money that I have not spent in the budget? Because sometimes we're within our budget, but someone has gone somewhere where we don't know, So we must have those discussions and conversations. If we don't have that, we'll have a challenge. So budgeting is very important, and then saving. So within your budget, there must be an element of saving, and saving continues all the way. It's basically a constant matter that runs across our lives, because we should always have some back pocket for emergencies that can come through in our lives. So in terms of savings, we must make sure that we are saving in instruments that either are giving us credit or they're giving us an income, and also transforming them into investments. We're talking about strategic investments and risk management. So we must transform our savings from savings into investments. Why? It's because savings alone, if you are putting in a bank account, or you are saving in a circle, or you are saving in whatever place you are saving, the income on savings may not beat inflation. So if you want your money to buy you better in the next 5 years, next 10 years, then that money must grow with investment income that beats inflation. How does it do that? By putting in investments that are giving you money and giving you a better return, and where you have also looked at risk, return, and liquidity. So those are the things that we need to look at that particular time. Now, I don't want to go into the area of planning for retirement and distribution, because that's an estate planning. That's a whole area altogether that we can talk at another date. Now, first check management is that, at this stage, as a professional, there are many priorities competing for your attention, that saving may be the last thing to think about. And as I mentioned, you coming from the university, hopefully you have these loans, school loans, university loans. You are looking at, when am I going to settle down? You're looking at, maybe you want to buy a house, you want to buy a plot, you want to buy whatever you want to buy. So many things run around your mind. But one thing that you should never lose focus on is basically savings. Savings is critical. Let me tell you one thing. It's because it creates a war chest to help you invest and to help you have a fallback in the event you have a challenge. So savings, areas you need to save, you can save in personal pension plans if you don't have a company scheme. Now, if you have a company scheme, you can actually save in a company scheme. Now, the company scheme comes with a lot or saving in a pension plan comes with a lot of advantages. Because today, if you are earning, I'm taking an example of Kenyan tax regulations. If today you are earning 100,000 Kenya shillings, or roughly $1,000, and you are saving 10% of that amount, the 10% you save, which is about 10,000 Kenya shillings, or maybe $100, that amount is not taxed. So in a normal circumstance, you are 100,000 will be taxed at 30%. So your net take home is 70,000 Kenya shillings. But if you are saving, if you are saving 10% in a retirement benefit plan, then your taxable pay is not 100. Your taxable pay becomes 90. So therefore, your tax is 2,700, or 27,000 Kenya shillings, which means that you are saving 3,000 shillings every month you save in a retirement benefit plan. That's one thing that most of us don't know. And therefore, we pass the pension plans. We say, no, I want to save in a pension plan because I want to save in an investment club. Now look at this. If you have a salary, you are getting your whole salary of 100,000, you get taxed at 30%, you get your net of 70,000, you get 10,000 after your 70, and buy shares on the stock market. That money has been taxed. You buy shares on the stock market. The dividend you earn on that stock market is taxed. So you are taking your taxed pay, putting in an investment, that income is taxed. But compare with this. You take your 10,000 and it's not taxed. You put in a pension plan, and that pension plan has a tax exemption. What happens is that your investment income, when the pension plan buys shares in the stock market, the dividend is not taxed. So why would you do what somebody is supposed to be doing for you, and you get a tax advantage, and you get professional advice? So critical thing needs to be looked at. You need to ask yourself, can I save in a pension scheme? Now, if you don't have a company pension scheme where you are working, we have personal pension plans which are set up. Like we as Octagon Africa, we have Octagon personal pension plans, both in Uganda, in Kenya, in Zambia. These personal pension plans are basically to help the people who don't have opportunity to save in a corporate scheme to save for retirement, which becomes critical. So you can join that personal pension scheme anytime, and you can conduct your offices, the offices in different countries anytime, and you'll be able to start saving. Of course, investment clubs are critical. If I look at a country like, for example, Uganda is run heavily by investment clubs, of course, because the SACCO movement is not as much. So you find that most people are investment clubs. Why? It's because that's where we can be able to save. Where we can put our monies together and be able to buy either assets, or when we have saved, we get our return, because that money is either invested in bonds or invested in fixed deposits, and we are able to get a return at that particular time. So investment clubs are important, especially for young people, because you encourage each other. One of the reasons why investment club is important is a forced saving that makes sure you cannot be able to draw your money, because you feel you have an ego, especially for men. You are saving 5 of you. Each one of you saving 5,000 or $5 or $50 every month, in an investment club. You feel guilty to say, I want to withdraw your money because the rest of the people are saving. That guiltiness helps you to push your investments forward. We must use everything around our lives to make sure that we have savings which are created for us to be able to make it in life. Of course, SACCOs, as I mentioned, savings and credit organizations are critical as savings vehicle, which can help us get credit at the end of the day. Kenya is majorly driven by SACCOs, and SACCOs are, of course, SACCOs and pension schemes. And SACCOs are critical because that you are able to create money, and in the future you can fall back to either get a loan, and sometimes they'll give you a loan of 2 times or 3 times, or some of them will go to 5 times of your savings. It's very important, a very critical savings platform. Life insurances are important. Life insurances are important. Why are they important? They are a forced saving as well. A life insurance, when you take a life insurance, and I'm talking about life insurance, I'm not talking about your group life if you're in an organization. Group life insurance is a term insurance. It doesn't have an investment element on it. So what happens is that you take a group life in January, you don't die by the end of the year, you lose, have premium is gone, you renew the policy. There is no money that comes to you, If you take what you call an endowment policy or an anticipated endowment policy, a straight endowment policy is one that where you take a 10-year plan or a 15-year plan. You pay on a monthly basis. The premiums are a little bit higher than group life, but you are paying for a sum assured. So the sum assured could be, maybe for argument purpose, $100,000. So $100,000 is what my sum assured is. The premium I'm paying today may be $10 or maybe $20 or maybe $30. You pay for the next 10 years, and at the 10th year, the policy matures, you get your $100,000. Now that's a good saving. It may not give you a good return. Let me tell you one thing. It may not give you a good return, but it is a place you put money, you may not get it back until the 10 years. You get it? It helps you to have a forced saving, because sometimes we say, oh no, it doesn't give me a good return, but where's the alternative? Which alternative where are you putting the money as an alternative investment to give you a good return? Young men give reasons why they don't want to take insurances. The companies will collapse. Insurance companies will not pay. Those are excuses. We have invested in insurances. I personally have done insurances, I think 4 times. The first 10 years matured, second 10 years matured, third 10 years matured. I have a policy today and it's running. It's going to mature hopefully when I retire. The thing is, is that when it matures, you are able to use it to do something that you want to do in life. But then if you take anticipated policy, anticipated either education policy or a straight life anticipated policy, an education policy will start paying maybe in the 5th year, and every year they pay you a percentage of the sum assured. The bit about that is that it helps you towards paying school fees. So if you today you are 25, 30, whatever it is, you are getting married, or you have gotten married, you are getting children, you must understand that those children will go to school at one particular time T. They will require money. And don't think that you just get from your salary and pay school fees. It normally never works that way. People who go that direction, they find themselves in serious financial challenges, because you will go for a loan to pay school fees for the first year, and the second year you're still paying the loan which you took last year. Then you find yourself going into a rat race. You must use those fixed costs that are going to come in the future, that are obvious, that are fixed. You must ensure those costs now. And education policy is a critical one. Straight anticipated life policy is an important policy. Now, once you have done savings, you have done savings in your circle, you have done savings in your clubs, you have done savings in your insurance policy, and you are getting your money, and you are asking yourself, where do I want to invest this money? Again, the first 10 years, which is 25 to 35, investment is critical. So you don't just save. I had a young man who one day I met, and he was telling me, I'm very rich, and I asked him, how rich are you? And I said, I have, I think he had almost $30,000 in a bank account, in a savings bank account. To him, he was very rich, and he was doing very well. And I told him, that is wrong. Why would you have $30,000 in sitting in a bank account, giving you an interest rate of 2 or 3%? You know what the bank is doing? I know bankers are here with you are doing a fantastic job for us, but you are very clever than most of us. So what you do, take my $30,000, put in a bond, and the bond earns 12%, and you give me 2%, you remain in 10%. So who is a fool? Who is a fool? Why not you yourself walk into your Bank of Zambia, Bank of Uganda, or Central Bank of Kenya, and register for a bond, register a CDSC account, invest in your bond, and you get your 12%. We sometimes make very interesting decisions. So you do not take money, savings, and stack them in a savings forever, because the income you get on a savings account, or any savings that are not necessarily investments, they don't give you a return that surpasses inflation. As a youth, the most important place that you must have, if you have a stock market in your country, then you must invest in shares. Shares are an important place. I made money myself when I was a young man in shares. Sometimes people think you are running mad by going to buy shares in the stock market. That's gambling. It's not gambling. It's basically putting money in a company and believing that that company will be able to perform well, and give you a dividend. But over and above that, because at a young stage, you're not looking for a dividend. You're looking for capital gains. In fact, you should never focus on dividend between 25 to 35, even 35 to 45. Never focus on dividend. Look for stocks that are fast moving, which means that today the price is 20, the next day the price is 25, the next day the price is 30, the next day the price is 15. That is a good stock, because when you buy at 25, peradventure it goes up by 5 shillings, you are able to sell at 5 shillings as profit. So you must then be doing one thing and asking yourself, what do I do to be able to make money? One is in shares. Shares are critical. You don't buy to hold, you buy to churn. So every other time you're looking at it and saying, how much money, how much increment have I got on my share price? Give your stockbroker in instructions, sell them, buy stocks at a lower price, wait for another 1 or 2 years, sell them. That's the only way you will be able to do. So you must have some money in that portfolio. And I always tell people that when you are investing in shares, don't invest with short-term needs. You don't invest in shares in January expecting to sell in May or June, or even next January to pay school fees for children. Because stocks have almost a 5 to 7 year cyclic. They will go down for 5 years or 7 years. They will come up for another 5 or 7 years. So you may just be buying when it's going down. and you may wait for another 5 years. Yeah, so you must, first is that you must buy stocks when they are low. When everybody is getting out, that's the time to buy, because they are on the floor, because the companies are not collapsing. If you have a company in your country which is invested in the stock market, it is, let's say, for example, in Kenya, we have Safaricom. Safaricom is the largest company, I think, around the African markets. If you are investing in Safaricom and the price comes from 45 like it did to 25 like it is today, people rush to the market to sell, saying they are going to lose their money, when they are still giving Safaricom money in terms of airtime and bundles. When Safaricom is still declaring dividends that are high, what is the risk? Why could it be going down on price? Sentiments. It's because maybe markets, international investors are pulling out. So you must understand the markets and invest in shares as a young man. Unit trusts are important, because unit trust is another good place to diversify. So I'm not saying that you put all your money in one of these. Put your portions in different asset classes. Why? It's because when one is going down, one is going up, and when you have a challenge on one, you can be able to reach on another one. So unit trusts are good. Why? It's because they give you the opportunity to invest in more asset classes. They will invest in bonds, they will invest in shares, they will invest in fixed income, in fixed deposits. They can, some of them invest in REIT in terms of property. So they can expose your money on different asset classes. Yeah, but if you have the opportunity to invest directly in shares, it's a fantastic thing, because you get a higher return. So these are the assets that you invest in. And I always say that as a young man, shares should always be highest in terms of asset class, coming down to property should always be the last. And property, when you invest in property, when you are young, you are not going to, at 25 or 35, maybe you have invested some money, you have gotten your loan in a stock, or you have invested shares, and the money is turned around, it's given you good money, you decide to go and buy an apartment to be able to start renting. That's not a business for a young man, because a return on property is never more than 6% in terms of rental income. Yeah, and apartments, you will never go more than 3 to 4% in terms of capital appreciation. So you're looking at a return of about just about 9 to 11%. But yet you can put your money in shares, you can put your money in bonds and get a higher return. Because you are young, you should put in assets that you can channel quickly, and also ones that can give you higher capital gains and you get out of them. And for property, we always advise land banking. Land banking for younger people is the best property investment, because you look for plots in areas that are growing fast. You buy a plot in a commercial area where your plot is growing fast. In the next 3-4 years, your plot has doubled, and you basically move out, and somebody else comes to take over, because land is basically is not going to expand, and yet population is increasing. So you'll definitely, if you buy land in terms of plots, where we're talking about in commercial areas, not going to buy land in the villages, because those ones don't appreciate as much. So you're looking at land banking becomes a critical bit as part of your investments. Quickly, in terms of mid-career financial planning, basically it's how to manage your midlife financial planning. By this time, ensure that you have enough savings in your pension. I've talked about it. Additional voluntary contributions in your pension fund, in SACCO, any other investment model to secure yourself during emergencies. But this is the time that, as I mentioned, midlife has a midlife crisis. This is the time when you, as a person, you are going to HR manager, and HR manager is telling you, I can't be able to promote you unless you have a master's, or you have, add yourself some certificates. For you to add, you need money. Your spouse is also going through the same. She requires money, or requires money. And then your parents are aging, so you are taking care of medical care for your parents, because in Africa we don't do post-retirement medical savings. So our post-retirement medical savings on our children. So you are in 35 and 45, you're taking care of your parents who are aging and they're getting medical challenges and they're going to hospitals and they're being admitted, you need money. You know, so all this pressure, your children are going to school at that particular time, all this pressure is on you. And that's why I said in the first 10 years, it must be purposeful saving. It must be purposeful saving and investment. Please don't squander your opportunity in the first 10 years. Once it's done, it's done. You will never reverse and say, let me go back and do it. If you are here, you are young, take the advantage and save. Save in a retirement benefit plan, save in a circle, save in an investment club, save using insurance products. So I think I want to stop there at this particular moment, because I think this was just basically to mention in terms of what needs to happen, and maybe get questions if there are any questions from the floor.
Thank you so much, Fred, for that wonderful presentation. I see Felix and Dr. Joshua have raised their hands. So I will start by unmuting Felix so that we can hear your question. If you don't want us to hear you, we'll still love to hear your questions. So please feel free to type them down on the comment section and we'll be able to address them. Felix, your hand is down. Okay. So let me unmute Dr. Joshua. Dr. Joshua, you're unmuted. You can unmute yourself and ask your question. Dr. Joshua? Okay, as Dr. Joshua gets ready, I also see that Arthur has raised his hand. So Arthur, feel free to let us hear your question. I've already unmuted you, so you can unmute yourself. Arthur, the floor is yours. If you're unable to speak, you can also chat down your question. Oh, Dr. Joshua, you say that you're not able to unmute yourself. Let me try again. You can try that now. I will go to the next person, Brian. Just press the microphone button. All right, I see that Arthur is also not able. Sorry? Yes, Brian.
Okay, thank you. I think I've managed to press the unmute button. So my name is Brian, and thank you, Fred, for the excellent presentation and the great insights, especially in the guidance about the savings and also the investment portfolio. I really wanted you to also just mention about something specifically within our Kenyan market on the money market funds, because I think it's something that most people are also trying to venture in. So I really wanted to understand, is it something that is really for long-term, short-term, and also what's your guidance in regards to investing in such portfolios? So thank you.
Okay. Okay. Do I maybe get a couple of questions before we answer, if there is anybody else?
Dr. Joshua, you can still try. Arthur, also still try to unmute yourself. I think it takes a couple of minutes. Kevin, also, I've already unmuted you. Okay, Dr. Joshua has put his question on the comment section.
Okay.
And he says that, what can you advise about investment in cryptocurrencies, especially Bitcoin?
Okay.
Right. Thank you, Mr. Fred, for your wonderful presentation and the entire team that is behind this very wonderful session. I would love to appreciate each and everyone who's making it available for us. Okay. Now, for starters, Mr. Fred, I would want you to help me understand the difference between the trusts and bonds. I'm in Uganda, and it is something that I just keep on hearing among people, but I've not really understood how the whole concept of trusts and bonds works, and the difference between the two, and how to acquire each. I mean, each of the two. That is where I want you to help me highlight it. Most especially, I know you could be having knowledge about those in the Ugandan market as well. So, interest in that.
Okay, thank you. Okay, I've seen Elizabeth asking about how to buy shares in Safaricom.
Yes, and Anthony is also asking how much more can you save extra in your pension fund without getting taxed upon retirement?
Okay. Okay, I think let me respond to this. One is money market funds. I think money market funds are basically they operate like unit trusts. We have money market unit trusts. We have equity unit trusts. And of course, balanced funds, which are basically between equity and money market. Now, money market is basically fixed income assets. These are bonds. These are corporate bonds, if we have corporate bonds, and then also fixed deposits. Government bonds, we're talking about government bonds, corporate bonds, fixed deposits. So a combination of all these plus cash is basically what we call money market. Now, what happens is that most fund managers, what they do is that they create a fund. They create a fund, and this fund is so they collect funds from the public and create a fund, and this fund invests in these very asset classes, which are fixed asset classes, where income is fixed. So you are comfortably sure that you will not lose your money, because if you put in fixed deposits, if you put in corporate bonds, if you put in government bonds, you are pretty sure that you will not lose your money, and you will definitely get your money. So, and that's why most people are going that direction. Why? Is because today the stock market is down. You have, the index is completely off. You find that stocks, as I mentioned, like Safaricom, which was going at 45 today, is about 25 shillings. KCB is down almost 15 shillings, or I mean about 15 shillings. So people don't want to go and buy shares. They want to go and buy to go to money market, because they know they'll get at least 9 to 10% return. Yeah, 9 to 10% return. It's just the mentality of human beings. This is going down. I don't want to buy it. I want to buy something that is fixed. Not knowing that it's going down, it's not going down because KCB is closing or Safaricom is closing. It's going down because the international investors have moved on, have left the markets. So therefore, leaving only institutional investors who don't trade on the market. Yeah, who don't trade on the market. So the few shares that come on the market that needs to be sold become very few, and therefore the price becomes nothing. So the thing is, if I was anybody who has money today and you want to invest, to make a better return, maybe in the next 2 to 3 years, you should be buying shares today on the market, because they are low, because they are on the flow. So pick those shares today, because those companies are not closing. Cooperative Bank is not closing. KCB is not closing. Safaricom is not closing. Yeah. So the price will likely going to go up. So money market funds, yes, is a good one for those people who are conservative, who basically just want their money to get a bit of a return, 9 to 10%. You are good enough. But remember that today our inflation is at 9.9%, basically 10%. So we must ask ourselves, where do we put our money that can beat inflation? So we need to look at that, and that's why alternatives in terms becomes important. Cryptocurrencies and Bitcoin. I think my thing is it's a good investment, but the risk is very high. Today I was doing a strategic plan for a pension fund, and the fund manager was presenting the movement of assets across the world, and cryptocurrency swings swings from a return of I think it was 3,500% to negative 6,400%. You know, now those swings are such a huge that the risk is extremely high. You can put in some money in there and you may make some money, but you also may lose the money in that very particular space. Now, if you're looking at making investments for future, you can take a bit of your assets and put in and take that risk, because risk is about whether you make money or not. But you can't take a bigger portion of your money and put in the cryptocurrencies, because first of all, it's never regulated. It's not a regulated environment. So I remember some friend of mine went to buying some, and he found it's buying from a wrong party altogether. So because of that issue, because of regulation, I always advise people that, well, you want to take the highest risk on planet Earth, you know, like doing a bungee jump, go and do it, you know, but the risk is quite high. People are investing in it. I know some people are making money, but some people have also lost money. Trusts and bonds. Now, that's a very wide or comparison. Now, bonds. Let me start with bonds. You know, looking at things like bonds, we're talking about government bonds. Government bonds. How government gives out bonds is that the government doesn't make money. The government is not in business of making money. The government comes to you as individuals. Of course, it only makes money by collecting taxes. Yeah, collecting taxes. Now, in most cases, taxes are not enough to run government. So they have a budget of 1 trillion. If you say in Uganda, they have a budget of 1 trillion, but they can only collect 1.5. I mean, maybe they have a budget of 2 trillion. They can only collect 1.5 trillion. So there's 500 billion that they are lacking. What do? They either go and borrow from IMF or they borrow from local. So they come to you as an individual, you know, and issue a bond and say, if you give me your money, yeah, I will keep it for the next 20 years and give you an interest rate of about 16% or 15%. So they give you a rate of return of 15%, which is paid to you half yearly. In the 20th year, your money you have given them is paid back to you as a return, as capital. So that's how bonds work. So the government issues a note, and people buy into that note, and invest in that note according to the rate that has been given by the government. So a bond works that way. Now, you can have either government bond or a corporate bond. An organization like Octagon Africa can wake up in the morning and say they want to do expansion and they want to look for money. They can go on the market and look and tell people, we are issuing a corporate bond. The bond is for 10 years. If you buy this bond, we'll give you treasury bill rate plus 2%. You know, and we'll pay you back interest every half year or every yearly out of that very particular investment. So people buying that bond have to, you know, when they look at the company, they look at the company growth, they look at the company stability, they buy that bond. That's what we call a corporate bond. But a government bond is issued by government. So that's what a bond is. In terms of trusts or pension fund trusts, you know, trusts. Let's talk about pension fund trusts. These are trusts that are set up to collect funds for purpose of investment for retirement. So, like for example, UBRA requires that every pension scheme, pension scheme must be set up under trust. So you set up a trust under what you call a document called Trust Deed and Rules, which is the document that defines how the trust deed is supposed to be managed. You know, so that's what trusts are and bonds. So the relationship is the comparison is a bit wide off. Yeah. Now, in terms of how do you buy Safaricom shares? Very, very easy. Very easy. Now the name goes. If you are in Kenya, there is an organization that does. You can go online, sign up online, your CDSC. And you can be able to invest online. They give you the shares that are trending today, and they give you the prices and recommend and say, can you buy this, buy that? So you make your own decision, of course, depending on what you want to buy. And then you put your money in your account, they debit the account, they buy for your shares, they create your CDS account. Very easy. So first you must open what you call a central depository securities account, and that's a CDS account which is opened through a stockbroker, an investment banker, and as I mentioned, now people are opening it online, so you don't have basically to work in these organizations and open that. We can talk on the sideline, and I give you the name once I remember what that name is. So buying Safaricom shares is very, very easy. How much more in terms of pension, in terms of tax? KRA in Kenya, it gives you up to a maximum of 20,000 shillings tax-free. So if you are earning 100,000 Kenya shillings, you can only get tax relief up to 20,000 in terms of contribution. If your contribution is more than 20,000, then the balance will be removed from taxed pay. Now, what happens is the 20,000, when it's invested, the income is not taxed. At the end, when you get the benefit is partly taxed and partly not taxed, because they're saying we didn't tax your contribution, we didn't tax your income, let us tax your benefit a bit. But today they are saying if you are at age 65 and you are accessing your money as a monthly pension, then that money is not taxed at all. So we are encouraging, if you are young today and you are save in a pension plan until you get 65. I know some young people, 65 is like, you are telling me I'll never see that money again. It will come very quickly, my brother and sister. So please remember to save and look forward to getting your monthly pension tax-free in 65. Okay. Do we have any more questions?
Yes, Fred, we do. I'd like to remind you, is the company Genghis Capital?
Genghis Capital, yes. That's very good. Thank you very much, Elizabeth. You go and Google Genghis Capital. You go there, they will allow you to be able to sign up a CDS account. You will sign up and start saving straight away online. I know people like us, we were lining up in stockbrokers to be able to sign up CDS. But today, young people, you can do it in a pub, in a restaurant somewhere. Yeah.
Thank you, Fred.
Okay.
So we have a question where they're asking if Octagon provides loans to those saving and use the savings as collateral. And then we have another one, which from Dennis, who is asking, how much return is my pension assets making on average, and how much has this accumulated to so far? And then Dr. J has a comment where he says there are people who bought Bitcoins when the price was low and sold when it shot up, and they made lots of money. Walter says, good evening, Fred, and thank you for the excellent presentation. My question is, in an event of an emergency, should one use the savings or go for a loan? Thank you. We have another one from John K, who says, can an individual person buy shares without using the listed share brokers in the stock market?
Come again?
Can an individual buy shares without using the listed share brokers in the stock market?
That's a no. Straight.
John, you've gotten your answer. And then I can give you one from Evelyn, who asks, what's the interest rate for individual personal pension in comparison to money markets?
Okay.
Do we continue, or will you address those first?
Let me address this one's first, against money market. Okay. So first is Octagon. Does Octagon provide loans? No. We don't have a license for banking. Neither do we have a license for SACCO. We have a license for people saving for retirement. So when you save with Octagon personal pension plan, or you are in an occupational scheme, you are saving, you save for retirement, you don't save to be able to get loans. The Retirement Benefits Authority does not allow people to get loans from pension schemes unless it is money that you are drawing for purpose of mortgage, which is a different subject altogether. So we don't provide loans at that particular time. And returns on assets, Returns on assets. Somebody asked, well, how much returns am I getting on my asset? I don't understand that. I don't know whether it's assets in the Octagon pension or the assets in the scheme they are in. So I need to get that clear. Emergency savings, or go for a loan if you have an emergency. You know, I always say that you must have pockets of savings. Pockets of savings. So you must have an emergency saving pocket. You must have a pension pocket saving. You must have pension saving. You must have school fees for if you're planning to go back to school to do, that education savings. You must have, if you're going to get married, you must have a saving for marriage. You can have pockets of savings. So what happens is that if you get an emergency, go for the emergency savings. It's an emergency. So you don't go for a loan to sort out an emergency, because ideally a loan, I always tell people a loan, 70% should go into an asset that is either appreciating or go into an investment that gives you a return higher than the return you're making on a loan. You're paying on a loan. So if you're going to get a loan from a SACCO, you're getting £1 million shillings, make sure that 70% is going either into an asset that is appreciating, or it's going to an investment that is going to give you a return that is higher than what you're getting on a SACCO. That's a good financial decision. You take a loan to be able to sort out an emergency. In my view, you are getting into a challenge and you soon get into a rat race. Yeah. The second, I think that's what, yeah, the second is, I said, buy shares without stockbroker, you can't. It's only through a stockbroker. Interest of IPP against money market. The interest of IPP, you will always find them to be about 10, 12%, sometimes goes up to 15%. Money market is fixed income. Fixed income, you will not get interest more than 10%. And money market, I mean, if I was you, you have your 100,000 shillings, you have your 200,000 shillings, and you want to go and put in money market. Why just not go to central bank if you don't want to put in a pension fund? Go to central bank, open a CDS account. It's free. It is very easy. Open a CDS account and invest in the CDS account. So instead of money market person, because it's an agent, it's simply collecting money, sending to central bank, getting interest, cutting off his expenses and profit, and give you the balance. You can get the whole amount in your pocket. Yeah, you can get the whole amount in your pocket. So why not open a CDS account in central bank and get money? I remember one time, the time I went to open a CDS account in central bank some time ago, I met an old man who was almost, I think, about 70 years. And he told me, young man, you are making the right decision. He said, I opened this CDS account in 1984. I remember. And then he said, I have made a lot of money from this central bank. So I know we want quick areas of doing things, but if we can be able to be patient and go through the process of opening a CDS account and have your own account, you can actually invest in your own bonds. Those infrastructure bonds are critical, are good. They have no tax on them. You can invest in that, so you don't then have to go through money market funds, which scheme out their expenses and profits.
Thank you, Fred. Let's continue. Janet says, thanks, Fred, for the presentation. How does one access the life insurance companies and how much can come as a return? Any examples of such companies in Uganda? And
now,
then,
yes. Oh, sorry. Let me write them. Yeah. Okay. Just go ahead.
Yes, we have a comment from Arthur who says, thanks for the presentation. It makes a lot of sense to me, of course, because I made many of the errors and woke up around the age of 38. I was late. Maybe such talks could come in earlier, because what I came to know in the last 10 years, I wish I had known it when I was at 20 years. Perhaps there is a greater need to give these talks to help persons younger than 30 or thereabout how to avoid following the crowd of trends, expenses at the expense of one's own financial ability. Thank you for that insight. Winnie says, what about the current craze of infrastructure bonds for GOK? The rate seems high as the government is looking for money. How much exposure should one put?
Okay.
Let me repeat. She's asking about the current craze of the infrastructure bonds for government of Kenya. The rates seem high as the government is looking for money. How much exposure should one put?
Okay, so maybe I can answer those three. Maybe I start with that one of the infrastructure bonds. You see, the government all worldwide, they rarely or at all default on bonds. So when you're talking about exposure, you're looking at risk. And what's the risk? The risk is the government will not be able to pay interest, or the country will not be able to pay to repay your bond when it matures at the end. Definitely, it will do. They will pay both interest and capital when it matures. And I tell you the truth is that you haven't seen the highest. The highest is going to come. 14%, which was just issued on the last month's bond. It's basically it was called highest over the last almost 2 years. Yeah, but at the moment, government doesn't have money, and the government is looking for money, and they will definitely want money. If they go out on the market, on the international market to borrow, they're going to borrow in dollars, and the rate is quite high because, as you know, the Bank of the American Central Bank or the Federal Bank of America has increased rates to almost 4%. Now, more money is chasing that side because people now are going to invest in the federal side than investing in Africa. So what happens is that you go out to look for a euro bond, it will fail because you won't get the money. And if you get, it will be too expensive to be able to pay. So the only place they will have to borrow is local. So if they are going to borrow local, it means that the interests are going to go up because the people are going to say, okay, you can't borrow anywhere else. You want my money? You give me at 15%, at 20%. You remember one time in this country in 1993, 94, because of the Golden Back issues, the interest rates on bonds were 28%. 28%, and people are buying bonds at 28%, which were in 10-year bonds, 15-year bonds. So yes, you can have as much exposure as you want. I think government is the surest place you can ever invest. Yeah, but you should not put all your money in the current bond because the prices are going to go up. So which means that next month when it comes out, it will come out a little bit higher. Yeah, maybe it may not be an infrastructure bond, but it will be a normal bond, but the rate of return will be a bit higher. In terms of life insurance companies in Uganda, there are many. Of course, most life insurance Kenya are in Uganda. We have APA, we have life insurance, we have Jubilee Insurance, we have Britam, we have CIC insurance companies. So these are all insurance companies which are basically run life products. If you talk to our office in Uganda, Darius Niwa, our general manager, will be able to give you the details in terms of how do you then apply for these very particular products. Of course, our personal pension plan, we're creating a products around it in terms of life insurances, and that can also be a good thing. So you are saving both for pension and also looking at life insurance at the same time. Financial training for younger people, I appreciate your comment 100%. I'm passionate about young people. We as an organization are doing financial literacy for 15 to 22 every holiday for children on webinars. And we are planning to set up financial literacy clubs in primary and secondary schools as our CSR. Why? Is because that's what needs to happen. That's what needs to happen. So we don't get to 35, 38, 40 and we're regretting. We get there when we know that we should have gotten here because we planned to be here. So that's what we really want to appreciate that comment.
Thank you, Fred. Dr. Joshua asks, if you have money in a fixed deposit account, is it advisable to open a dollar account and have the money in US dollars because of the decline of the Kenyan shilling? And Daniel also asks, can I use part of my pension to access a mortgage to purchase a house, and what are the requirements? Then we have another question from Dennis, who is asking how much was reported as return on pension assets last year and before. Then we have another one from Anthony, who asks, would you recommend consolidation of pension savings into one when changing jobs?
Okay. Consolidation of pension savings. Okay. Whether you can, you have your money. Will you want to open a US dollar account and put in your US dollar account? Yes, maybe, because the depreciation of the shilling is likely going to go further, to depreciate further. Maybe that's a better. So you getting gains in terms of depreciating shilling. It's a good thing to do. But I know and I'm aware that for you to be able to open a US dollar account, you require quite some substantial amount of money for a bank to help to allow you to open a US dollar account. So, but that's a good investment for you to be able to do. At the moment, it's basically hedging funds against the depreciation of the dollar. So, depreciation of the Kenya shilling or Uganda shilling. I know Zambia, the kwacha is strengthening. So, if you do that, you're basically losing out. Mortgage to buy a house, yes, the law now allows you to use almost 40% of the amount in your account to the maximum of 70 million to buy a house. There are certain conditions that are provided in there. I think we don't want to go into detail at the moment. If you want details, I'm sure Elizabeth will give our contact, so you can be able to get in touch with us and we'll be able to give you that in terms of requirements. Returns on pension funds over the last 1 or 2 years, I think returns have been in the range of about 12 to 15% of returns of the scheme. I know last year itself, I think the returns were a bit lower, I think about 8 or 9%. But the schemes have done better over the years. Ideally, returns on pension schemes are better on long term. In long term, if you look at it over the last 10 years, 15 years, schemes have made about 17%, 15 to 17% of returns. In terms of consolidation of pension savings, that is the thing to do. That is the thing to do. I tell young people today that the best thing is to open your own personal pension account. So because people work for 10 companies before their 10th year of work. That's a problem. So what happens is that all these 9 companies you have worked for have your pension plan because you can't access the 100% of your money. You need your own personal pension account. Every time you move, you transfer your money to a personal pension account, which you can control, which you can determine where to invest, you can determine how to invest it. So consolidation is important, and you can consolidate in a personal pension plan every time you move, so you don't have to be moving from one scheme to another every other time. Yeah. Any other question? I think those were the 4 questions which I have addressed.
Thank you so much, Fred. We have 2 more questions.
Yes.
One from Florence, who says, thank you very much, Fred, for the insightful presentation. What is the minimum amount one can save on government bonds, similarly on corporate bonds? And then we have another one from Engulu, who says, thanks for the great presentation. Can someone with unstable income take a life insurance policy?
Okay. Unstable income on life insurance. Minimum on government bonds is 100,000. Yeah, if you have 100,000, you can basically invest in government bond. I think treasury bill is 50,000 if I'm not wrong. Now there's a difference between treasury bill and the government bond. Bonds are long term. Yeah, treasury bill now we have the longest is 1 year. But most treasury bills are 91 days. So treasury bills, I think 50,000 should be the minimum, but bonds is 100,000. But of course, there is also the hustler, what you can call a hustler, the Mwananchi bond portfolio, bond structure, which was set up by government about 4 years or 5 years ago, where you can invest as little as 3,000 Kenya shillings. So that is it, but that don't normally that's a small amount, to invest. But if you want to invest major amount in a normal bond, you go to CDS account. You go Central Bank, open a CDS account. The minimum is 100,000. Unstable income with life insurance, that's not advisable. If you have an unstable income, then you invest in things like pension. You invest in things like investment clubs, but if you go into life insurance must have a steady income that is able to go into insurance as premiums. Because if you save for 2 years and stop, you lose all your money at that particular time. You must save up to the level you can get a surrender value, which is about normally 3 years. So what happens is, if you save over 3 years and you are unable to save, then they can give you can give back your money. But the saving must be monthly. If you skip 1 month, the policy lapses. When the policy has lapsed, it cannot be revived. If you have to revive it, then you open a new policy, and the money you put in basically disappears. So you must have a steady income that goes into life insurance savings.
Thank you so much, Fred, for that wonderful presentation and for the way that you've tackled the question. I see we have another comment as we're winding up.
Yes.
From Dr. J. He says the main reason why people struggle financially is because they have spent years in schools but learned nothing about money. The result is that people learn to work for money but never learn to have money work for them. Rich Dad, Poor Dad by Robert Kiyosaki.
Absolutely. That doesn't even have to be explained. It is very straight.
True.
We must look for information.
So as we wind up, Fred, do you have any parting shot?
Yeah, I think for me is to basically encourage each one of us. Some of us have lived our lives. You guys are, most of you are very young. Please save. If you are not in a pension plan, join Octagon Africa Pension, Octagon Personal Pension Plan. It's a great plan. We have almost a billion fund there. We have over 5,000 members in there who are saving. If you are in a company pension scheme, please make sure that you increase your contributions by addition of voluntary contribution to utilize all your tax reliefs. Why would you leave them on the table? And if you're not in any pension plan, if you're in Uganda, you are not in any pension plan, please join a pension plan in Uganda, join a pension plan in Zambia, and we'll be glad. And those ones who are already members of our schemes, we really appreciate your savings, and we will make sure that your savings are safeguarded for future usage. Thank you very much.
Thank you so much, Fred, and thank you to each and every one of you who have joined this wonderful session, this wonderful evening. Thank you for engaging with us, for commenting on the comment section. I have shared our contacts on the comment section, the email which you can reach us out to, which is info@octagonafrica.com, and you can also call us at 0709 986 000. So for those who are asking for us to share this presentation, we appreciate that there's a huge number of you. So we are going to upload it tomorrow morning on our YouTube page. I have also shared the link to our YouTube page, which is Octagon Africa Group. We usually do this twice a month. We have very many insightful conversations that go on. So you can also go there and look at conversations that we've had before, and you can grow. For those who are asking about the training that we have for children, it's happening in December. I believe that you all signed up with your email address. So we're going to send the invitations to you. So be sure to also let your young ones join so that they can be financially secure from a young age. Thank you so much. I see many people asking for the presentation. Be sure to subscribe to our YouTube page, turn on the notification button. The link is there on the comment section. Just check it out tomorrow morning. You can go through this whole conversation again. You can also follow us on our social media channels at Octagon Africa. We do the same things on all our platforms. So thank you so much. I see that we're running out of time. So allow us to end this meeting right now, and be sure to follow us so that you can not miss any other webinar that we have. Thank you so much.
Bye-bye.
Bye everyone. Can take this opportunity to now leave. Thank you.